Welcome to the Building One Story at a Time podcast.
We're your hosts. I'm Katie Herbine.
And I'm Stephanie LaChance. Today we are joined by Stacy, Ohrel, and Paul Fazzini from Lancaster Mortgage Company. Welcome, Stacy and Paul.
Thank you.
Thank you for having us.
Why don't you guys start out by introducing yourselves? Paul, you can go first.
Sure. I'm Paul Fazzini. We're from Lancaster Mortgage. We brand ourselves as LMC Home Loans because we have branches outside of the Lancaster area and we lend outside of just Lancaster County. I've been with Lancaster Mortgage for 13 years. I was one of the founding partners with Lancaster Mortgage. Prior to that, we were with a bank. Stacy and I were with a bank. But prior to that, Stacy was with another iteration of Lancaster Mortgage. So I go back in the business to 1993, but as far as Lancaster Mortgage is concerned, we opened it in 2011.
Wonderful. And Stacy, how about yourself?
I was with Lancaster Mortgage at the original Lancaster Mortgage back since 1991. And then when first Lancaster Mortgage was sold, I was then with another company and then joined Paul back at the new Lancaster Mortgage 13 years ago.
Wonderful. Give us a little bit of information too on who Lancaster Mortgage Company is, maybe like some of your values and maybe why we at EG Solstice, why we're such good partners together.
Yeah, sure. Well, we've been working with EG for 2 decades, if not longer. And we've been, very happy with the relationship, and I think vice versa. We are set up more of I always like to refer to us as a boutique lender. We're a mortgage banker, but we're not a one-trick pony. And what I mean by that is we're not tied to one lender. We can shop around for different opportunities for our clients. We're local. All of our staff has well over 15 years experience. Our loan officers, well over 20 years experience. We bring a lot of products to the table. Our rates are competitive. And most importantly, our operations staff and our sales staff have seen so many different loans that they have the ability to slot somebody into a variety of different products based on their needs. We don't assume we know what the consumer wants when that borrower walks in the door. We don't assume they want a bread and butter 30-year fixed product until we ask some questions, and then we help consult with them and give them a few options.
Really the consultants and the experts in the field there, huh?
Yes,
Yeah.
Absolutely.
Awesome. Yeah, we're grateful to have you guys as a preferred lender and as such a good long partner.
Thank you.
Yep. Thank you.
Yeah. So we have a couple of questions for you guys. And I think the first one that we're all dying to have answered is now a good time to buy?
Anytime is a good time to buy. My quote is, marry the house, date the rate. If you find the house of your dreams, it's always a good time to buy. Interest rates are a little bit higher. You marry the house, date the rate. What goes up does come down. And when interest rates come down, circle back to me and we will refinance and reduce your payment, your interest rate, or even reduce your term. Save money in the long run.
That's a great point, Stacy, because you don't want to miss out on that opportunity because especially at least in the resale market, even in new construction, I mean, that one lot, it only exists in one place.
Right. That's right.
And that one home, like if I'm going to buy a resale one day when I upsize, I have like a few homes that I've been scoping out that are on my list if they ever were to come on the market. So
right. That's right.
I wouldn't want to miss out on that opportunity.
Right.
And that's a great point because we look at it, you have to look at it buying a home as far as when to buy. You have to kind of look at it holistically. It's not a today answer. You need to look at what are my goals long term? What am I looking to do here? Owning a home is the American dream. Well over 70% of people want to own a home. It's very popular in the people that are coming to our country. They want to own a piece of America. They want to own that American dream. So for new construction specifically, since that's where EG focuses, we try to look at a longer picture because most clients aren't buying an EG home today and selling it in a year. So is now a good time to buy? We've had clients say, well, I want to wait for rates to come down. I'm not sure homes are going to appreciate. I don't want to lose value. There's a lot of data out there that shows that over time, that will not, more than likely will not happen. Even if you go back to the challenging times in 2006 and 7 and 8, we fought through those and had some depreciation, but it quickly turned around. And again, if you go back and look at the whole picture, if you wait too long for quote unquote rates to come down, so are 2 million other people. So
Right.
you're going to get into a bidding war. You're going to get, you're going to lose out on some appreciation. And it just exactly to Stacy's point, more of our clients that are purchasing now state, I know the rates are higher. I feel like they're going to come down and I will refinance at that point. But I don't want to get into this feeding frenzy 3, 6, 9, 12 months from now when rates dip and the floodgates open. I want to get ahead of that.
Yeah, that's a great point you make. And actually, we worked with someone recently that had been shopping for 2 years, waiting and waiting for rates to go down.
Yes.
And then finally they pulled the trigger, and the rates aren't necessarily any lower than they were 2 years ago, but at least they got in when they did.
Right.
And prices may be a little higher from 2 years ago.
Mm-hmm. Absolutely. Could you talk a little bit about the current rate environment and how rates tend to decline when the economy slows down?
Let's talk a little bit about what the Fed does. If that okay? Is
Sure,
that
of
okay?
course.
So let's talk about the Fed. We all hear about it. You hear it on the business news. The Fed's meeting, the Fed's raising rates, the Fed's lowering rates. Let's talk about what that means. The Fed is the Federal Reserve, and the Federal Reserve is the nation's bank, so to speak.
Mhm.
And under the Federal Reserve is what's called the FOMC. And under the FOMC, they're the ones that decide what the Fed funds rate is. The Fed funds rate is the rate that banks lend to other banks, that charge other banks for a loan. So, for example, if there's a national bank that receives a lot of deposits for whatever reason, some money comes in, whatever, internationally, it doesn't really matter. That bank is required to hold a certain amount of reserves aside. They can't just lend every single nickel that they have. If they fall short, they have to go borrow. So they'll reach out to another bank and borrow from another bank overnight just to meet that reserve requirement. That's the rate that the Fed sets, the FOMC sets. And when they adjust that rate, that's what affects everything else. So if it's more expensive for your regional bank to borrow money from another bank, well, that's just going to cascade up to everything else, whether that's a car loan, a student loan, a charge card, a mortgage. So that's what the Fed, when they say they're controlling rates, they control a very short-term, overnight rate. However, when that gets more expensive, so does everything else. We're in the environment now where the Fed has increased rates the fastest it ever has.
Mm-hmm.
The Fed fund rate, it's usually in a range. It's currently at 5.25 to 5.5. Back in 2022, it was as low as a quarter, 0.25 to a half. So obviously that was a significant increase. And the reason they did that is because when the economy gets too active, wages start going up, which means prices start going up, and then you have inflation, which is what we've been dealing with for the last 30 some months.
Mm-hmm.
So as inflation has excelled, the Fed raises interest rates over and over and over and over every month until they feel the economy is slowing down, that wages are slowing down, prices are slowing down. And then once they start lowering rates, you're going to have the opposite effect. So there's a statistic for each percent that the Fed increases. It takes, I think, like 1.8 million people out of buying. And the opposite will occur as rates start declining.
Mm-hmm.
Rates will decline. It's interesting because the Fed doesn't want to decrease rates until they see the economy slowing. And they gauge that by a couple different ways. They gauge it by, our prices increasing more than 2% a year? and currently it's at 3, but it was as high as 8 or 9. The other one is unemployment going up. And for rates to come down, you need unemployment to go up a little bit. And it's unfortunate because that means people have to lose their jobs.
Mm-hmm.
And that's always a challenge that you don't want to wish for that because you want lower rates because it means somebody's out of a job. Unemployment ticked up last month. It went up to 4.1%. The Fed likes it to be below 5, but above 4. They are on the record, and they've been on the record since the early 70s, that they want inflation to be no more than 2%. We're currently at 3, maybe just below 3. And they won't wait for inflation to get to 2%, but they want to see that it's headed toward 2%. Jerome Powell is the chairman of the Fed. He just said that a few days ago. They just want to see that they're heading in that direction. Once that happens, it won't take mortgage rates from 7.5% to 3%, but it'll slowly start, again, the cascade effect. It'll slowly start having an impact on mortgages over a few months.
And last week, rates had dropped a little bit over the past few days prior, and it's the lowest they've been in 4 months.
Right.
Oh,
So
wow.
that's a great
that's
point.
that's encouraging.
Wow. Yeah.
And then to Stacy's point, that was just based on the Fed seeing with
Unemployment.
unemployment
Mhm.
slightly going up
Yeah.
and inflation slightly coming down. So just the rumor of it, or just the insinuation of it, is what Stacy was saying, is exactly correct.
So hopefully 2025, we will see a decrease.
Yes.
Wow, I have never had anyone explain like in such plain detail what the Fed actually is and does. Like I've always heard them talk about
Stephanie, isn't it so exciting?
Well, I find it really interesting that you mentioned that for every amount it goes up, 1.8 million people are kind of pushed out of the market. It doesn't feel like that here in Lancaster County. Like it still feels like we have a lot of buyers and we have more demand than we have supply. So that's just interesting that we're kind of in this environment where there are probably a lot of people who are waiting because they can't move now, but yet there's still a lot of action going on.
Right. There are, and Stacy can speak to this probably better than I, since she's more on the talking to the consumer on a regular basis. There are many clients that are in the market that are trying to bid for a home that are losing out.
Yes. They're
And
still losing out and still offering more than the list price, which that's when clients get frustrated and then turn to new construction so they don't have the bidding war. Yeah.
right.
Mhm.
Which is where, and there are statistics out there that show that, and this is different than the crisis that we had in 08, 07 through 010, call it, or 2010. The builders were building too many homes. They were building homes faster than families were forming. And that has shifted. It's been this way for probably 7 to 10 years. There are buyers, but there are not enough homes. So builders are trying to build as fast as they can, but resellers aren't selling. And we could talk about that. There's some reasons for that. But as I tell everybody, builders have inventory. So resale inventory is there's not a lot out there, but builders have inventory, and the family formations continue, and they're projected to continue. And if I'm not mistaken, I believe the stat is we're 2.3 million homes in the hole versus family formations.
That is an insane amount.
That's an insane amount. And that's just everywhere. That's nationally. I mean, obviously Lancaster and central Pennsylvania shares in that.
Is there anything else you want to add about just general lack of inventory or why people aren't selling their homes?
Well, you hear a lot of clients that are, or potential sellers don't want to sell because they're in a low interest rate. They're in a 3.5% interest rate, a 3% interest rate. They don't want to leave that rate. And that's what they call the lock-in effect. And what that means is as rates go up, they feel locked into that property. Why am I going to exchange my 3% rate for a 7.5% rate? And that there's some value to that. I mean, that's not unrealistic. But a couple things are going to happen. I think most clients understand we may not get back to 3.5% ever. That was artificially low and historically low for a variety of reasons. But once we get into the low sixes, mid fives, even if you have a 3.5, they're going to look at that as what I refer to as a blended rate. Okay, well, 3.5 was really, really low, and I enjoyed that for 10 or 15 years. I can stomach 5.5% for a couple reasons. The biggest reason is they have built up so much equity that now they can take that additional equity as a seller and put it toward the
larger
new
down
home.
payment.
Right.
Yeah.
Correct. So that offsets some of that. And again, just back to our original conversation about why now is the time to buy, because when that all happens, all those clients that are sitting on 3.5 that want to sell, they're going to want to buy. They may want to buy a EG home or another home, and then that's just all going to push up the sellers. I mean, it's going to be another demand's going to exceed supply, in my opinion.
Something interesting I noticed. So my future mother-in-law, she likes to take pictures of the newspaper and text it to me. So she texted me the recorder of deeds records from the newspaper, something she wanted to point out to me in there. But I was reading through them, and most of them were like family to family transfers for like $1. Right. So I thought it was like more than half of them were that. So I was like, wow, these are like a lot of properties that are never even hitting the market. They're just staying in the family. Just something interesting.
Yeah, that's a good point. Yeah, they're trying to help a lot of
the younger generation.
Yeah. Stacy sees this with parents calling and say, "I'd like to sell the home to my child. How can I make that happen?"
Right.
Yeah, that's wild.
Yeah.
What are some other factors that would impact the mortgage rates? Kind of looking at.
Yeah. So we hear about the Fed. And the Fed increasing rates, decreasing rates, Fed. That's what we always hear.
Right. That's what everyone says. That
it's in the national news. And I have to say, clients are very tuned in to what the Fed does. I'm very impressed when I talk to a client. They are very educated. They know when the Fed's meeting. They know what's being projected. It is the client nowadays is way more educated than they have ever been, in my opinion. I'm not sure if you noticed the same thing.
With the internet.
Yeah.
I think there's a lot of good information on there, and then there's a lot of misleading.
There's other things that can lead toward rates adjusting, and the biggest one is international events, and that could be weather events. A hurricane, a earthquake, a typhoon, or it can be something like a war, something happening in the Middle East. When there's upheaval throughout the world, money rushes to the United States. It's called a flight to quality. That's what it's referred to as, a flight to quality. And what that means is, if you have money invested internationally and there's a war that breaks out unexpectedly, a coup, something that we didn't expect, the world didn't expect, money goes to safety. So it comes to the United States because the United States will always back up the money that it has. When that happens, it becomes a supply and demand issue again. So if all these banks are taking in money and people are putting money, they're moving it from some country overseas to United States, they're putting it in money markets, CDs, mortgage bonds. A lot of times they'll just buy federal treasuries. When all this money comes in, again, it goes back to supply and demand. When all this money comes back in, those money market accounts, the bondholders, they don't have to pay as high of a rate because they don't have to compete for money. It's just coming in. So when that money keeps coming in, they can lower the rates they're paying because it doesn't matter. It's still going to come in. And when the federal government lowers rates, or these banks lower rates, or bondholders, corporations lower rates, mortgages don't have to compete as aggressively for that money, so they lower their rates. Most of it follows a 10-year bond, kind of, sort of. So that's where you can see rates decreasing regardless of what the Fed does, and vice versa. If there's an event in the United States, the opposite effect can happen, but that's extremely rare. Most of the money is, again, referred to as flight to quality, comes to the United States.
That's so interesting.
Yeah, it is. It is.
And generally, when bonds are down, rates increase.
Correct.
And when bonds are up, rates decrease.
So I've noticed a lot of people that have purchased like their first home, maybe like it was their starter home. And instead of selling that starter home, they're keeping it as an income property and then moving up to a different home. How does that affect the market? And does that have effect on market and rates at all? Like the idea of people wanting to be property managers or have that kind of flow of money without selling their first home.
Do you want to take
I
that
think
from
a
a
lot-
qualifying?
I think a lot of people are doing that now because rent is so high.
Yeah.
So they're able to make enough money to cover their mortgage and any repairs that are needed. They then do not have the equity to purchase their next home.
Mhm.
They don't have as much equity unless they would do a home equity line of credit. But that's another monthly payment that you have then. And
Yep.
the home equity line of credit rates right now are higher. So if the ratios work, it's fine. Some just do not care to do that because they don't have the larger down payment for the new house. So it
Mhm.
kind of depends on the price range you're looking to jump to. If you're looking to jump just a little higher than the home that you currently own, it's not as bad and the payment's not going to be affected as much with less down. But if you're going to a higher sale price,
Right.
it could be a significant difference.
Interesting.
Yeah.
Yeah, I wonder if rental rates will come down once there's more housing on the market. We can cut this out. I was just curious.
Yeah.
No, that's a good question. Because one of the motivators of people wanting to buy a new home because they don't want to keep paying their landlord's mortgage, and they feel a little bit locked out because of these interest rates. So clients that are moving forward, they are probably stretching a little more than we've seen in the past. However, they've rationalized a few things. One we talked about, which is, as Stacy said, when rates drop, they're going to refinance. Secondly, they look at their positions and more clients are working from home, so they feel like they have a little bit more discretionary income to offset that payment. They expect to get raises over time. They'll get raises throughout their job history, and on top of that, promotions maybe. So they're looking at it a little longer term versus, geez, I can't afford this payment today. But when you have that rent going up every year, that's enough to wake enough clients up to say, let's just go buy a house, and have our own piece of the dream.
Right. Pay ourselves.
Yeah,
And
exactly.
I hear that a lot with the new townhouses at Lime Spring. I mean, there are some apartment complexes that the young couples, the young professionals are paying $2,800 a month, and they could put 5% down and buy a townhouse and gain some equity.
I'm sure this is a question a lot of people have on their minds, but how does the upcoming election impact interest rates?
Yeah, so I'll give a short answer on that. The short answer is not much. Slightly longer answer is, statistically speaking, if you look back throughout the past elections, there's a little uncertainty leading up to the election. There's a lot of wrangling back and forth by all parties trying to say what'll happen, what catastrophe will happen, whether one party gets in or the other. There's usually a little bit of a ripple effect after the election through the end of the year that nothing really happens. Everything is kind of quiet. And then once the new or current administration gets back in, things seem to settle down and go back to normal, so to speak. Now, that obviously, if somebody starts making some changes on regulations or helping some first-time home buyers achieve the American dream, but for the most part, there's a little bit of a lull before the election, after the election, and then it quickly goes back to I feel where we are now, which is we're still short on inventory. builders are going to continue to win because they have inventory.
Would you guys still consider owning a home to be a good investment?
Absolutely.
It is. And again, I look at if you're going to live in the home for an extended period of time. If you're going to buy a home, sell it in a year or 2 years, you may not realize some of the investment gains. And again, there are statistics that are out there, and you can Google them. They take, on average, the net worth of a renter, which is around $10,000, versus the net worth of a homeowner over time. And I think it's like $300 and some thousand, which is significant. Now, that $300,000 isn't somebody saving; it's them building equity in the home, appreciation, the value appreciating, and them lowering the balance by paying it each month.
That makes sense.
So that's how they build their net worth.
Interesting. Yeah, when I first saw that, I was like, how are these people saving almost $400,000?
Yeah, they're not.
No, okay, that's their
Like,
those are their assets.
That's their it's in their net worth.
It's not in their bank, right?
Correct.
Got it.
Correct.
Okay.
And your net worth in your home, you don't realize it until you sell it. It's like a stock. You
Yeah.
don't know if you made money or lost money until you sell it. Same with the home. That's why I'm saying if you buy a house today and sell it next month, you may not see some of that. Well, in this market, maybe, but over time, and again, I'm not an accountant. I'm not a financial planner. I'm not giving financial advice. But if you just do a search, you're going to see some of these statistics, which are eye-opening. They really are eye-opening.
Absolutely. What are some myths about home buying, or like your typical questions that you get when someone comes to you thinking they're ready to buy their new home? What are they usually getting wrong?
Some feel that you have to have 20% to put down. And there are programs out there we can do as low as 3% down. You'll have PMI insurance. PMI insurance protects the lender in case you default. The buyer has no benefits from it. But once you hit your 20% equity, that can be removed. But you can still purchase with less than 20% down. You can do it, and pay the PMI, and you're still better off than
waiting or
renting. Right. Rather than waiting.
Yeah.
Some will also think that you need perfect credit to purchase, and you don't need perfect credit. We have other programs that will go down to 580 credit score, which would be an FHA loan. A lot of documentation is needed, but it still will get them in the house. What's the other? As far as get pre-approved, the people do need to get pre-approved. A lot of agents are requiring pre-approvals now before you can even see the house.
Yep.
Yeah.
So that is, pre-approval is pretty much a necessity. And credit does need to be pulled, a hard pull for pre-approval. Some feel that you could do it with a soft pull, but we still require the hard pull. Other than that.
Yeah. And pre-approvals are free.
Right.
Yeah.
We don't charge.
Yep. I like this. Like, I don't need to get a pre-approval. I know I will qualify. But like, to know what your buying power is and have it in writing, I think is just so like monumental, and really helps to understand where your money can help you and what you can do with it.
Right.
Yeah. A pre-approval is Stacy taking the borrower's information and, stating based on what she sees in her experience, what they would qualify for. And you're right, Katie. The number one thing is peace of mind. It gives that client, I don't care what your credit score is or what your down payment is, it gives you peace of mind. But to your point, we do have clients that say, I know I qualify. That's usually not the case. The case is, let's make sure there are no surprises. Because a client that feels they qualify, when you pull their credit, there may be an error on their credit. I mean, we've seen, errors that people have a mortgage late that they don't even have a mortgage. It's strange now that's gotten better throughout the years, but there are errors on credit reports, and you want to address it now, not 30 days before you decide to buy a home or put an offer in. So, and the other thing is, income and assets. There are a lot of rules on income and assets that we have to make sure we as lenders are following these rules. And some clients assume we could do one thing and they may think it's perfectly fine, but when we look at it, it may not be the case. A good example is somebody switching from W-2 income to full commission, or they're in the same line of work as a W-2, they decided to be self-employed. There are a lot of rules on overtime, commission, bonuses, self-employed income that can throw a monkey wrench into that pre-approval. And that's where we really encourage clients. They can do it online. The application goes right to Stacy. They can download documents, financial documents if they wish. We really encourage clients to get that peace of mind and get it out of the way. And let's make sure there aren't any surprises.
Right.
Surprises
And
are for birthdays.
Some clients like to be pre-approved for the max. Now we're starting to see more that only want to go, they have a certain number in mind, and they do not want to go any higher than that. That's okay, but if they come here to the design studio and they see more, then sometimes they will call me back and ask to have another pre-approval letter. But the initial meeting, I'm seeing more that they don't want to go any higher than 700,000, and that's it. But then they come in here, they're at 728.
That's actually leads me into another question. Like, what is the process when somebody comes and they've first talked to you and they're like, this is as much as I want to spend. Mm-hmm. And then they come here and maybe they fall in love with that quartz countertop that they hadn't initially thought that they would get. What is the reapproval process? Or
I have everything already uploaded in my system. So I just go in, check where the ratios were, put in the new sale price, and 98% of the time, they're still okay.
Yeah. That's good. That's good to know, because we enjoy showing them a lot of stuff in here.
And you really need blinders in here if you don't want to go outside your budget. Let me tell you, beautiful thing.
And again, they're building their dream home, and they forget sometimes until they see it here, they realize, oh, yeah, maybe we should do that. It's things that they don't want to do after the fact.
And I encourage when they call and say the base price is $520, and I will tell them, once you get to the design studio, there's going to be, and some will say, I don't want to go any higher than $550. And, I'd like to push them to $6, but you can't, so hands are tied.
It's always interesting to sometimes the spouses disagree on where they want to be. And it's interesting to see which spouse wins and which spouse doesn't win as much.
See that a lot in here.
No comment.
Yeah.
It's usually a winner.
I know it is in my family. I say that much.
Well, anything else you guys want to add about market conditions, the state of interest rates, or just Lancaster Mortgage Company in general?
First of all, thank you for having us. I would like to add that Stacy's been with EG in our relationship for a couple decades, and we also have another loan officer by the name of Deb Martin. Deb, although she lives in York, she also covers Dauphin and Lancaster and obviously the York area. So I will talk personally. I am extremely fortunate and lucky to have Stacy and Deb. They are amazing. Their clients love them. They're honest. They're ethical. They will consult with the consumer all the way through. They answer questions. They work evenings. They work weekends. Both of them are amazing, and I'd be remiss if I didn't thank them for how well of a job they did.
Oh, that's so sweet. I can agree with you, Paul. Working with Stacy and Deb is always a pleasure.
Yeah, they're amazing.
Thank you.
Anything you want to add?
No, I just feel where interest rates are now, because I was in the business when they were in double digits.
Ooh.
I just feel that they're still okay.
Yeah. That's a very good point. We forget. You hear 7% and we think, oh my goodness.
Yes.
But historically, they're in that 6 to 7.
They're in the sixes right now.
Yeah, they're in the high sixes. Forecasting, the Fed may cut September, they may cut December. It's like a 50-50, but they will start cutting probably by the end of the year and into next year. But my advice would be, as we said earlier, don't wait, because whether we head into a recession or a soft landing, whatever we're doing as an economy, as rates come down, there will be another feeding frenzy. So don't just sit there and say, well, I'm going to wait another month for the Fed to cut rates. Get in the game now and do your best to try to move forward, and we will help put you in the right product.
Absolutely.
Or Deb or Stace.
I was going to say, start your home buying journey now, home building even too. Like, get your selections picked out. And then next year, when your home is done and you're ready to move in, ideally those rates are right in that sweet spot and you can just settle on your house. And
let's hope so.
Yeah.
We're with you on that.
Yep.
Absolutely. Well, thank you guys again so much for your time today and all of the knowledge that you've shared with us. It's so valuable and we really appreciate it.
Yeah. Thanks for having us.
Thanks for having us.
It's great working with you too.
Yeah, of course.
Bye.
Bye.
Bye.